For more discussions on the Fed's rate cut, we're joined by Jameel Ahmad, Chief Analyst at GTC, an online trading brokerage. Good to have you with us, Jameel. What is the expected timing for further interest rate cut by the Fed? Has the possibility of a soft landing for the U.S. economy now significantly increased?
Well, let's start with the soft landing metaphor, because actually we already saw from the data that the U.S. economy continues to be robust and it's doing very well, especially compared to its developed peers. Last year, the U.S. economy completely bucked the trend and was showing emerging markets like growth. One GDP figure was as high as 5%. We saw in the introduction then that the GDP for this year is still supposed to be somewhere around the 2.6% mark, which is economic growth that the likes of the United Kingdom, the European Union would be jealous of achieving. So I think that we were already going to have a soft landing. What's surprising is that the Fed has moved more than expected. It's been more aggressive. Up until this week, the base case scenario was that the US Central Bank would cut interest rates by 0.25%. In fact, they went bigger than that, and they did 0.5%. This suggests that there's some skepticism that maybe they have left it too late. But nonetheless, there has been some recent weakness in US economic data, particularly some of the ISM data, which might signal some global concerns weighing into the US narrative. At the same time, we've also seen two weak non-farm payroll reports, which is the monthly jobs reports. So perhaps the Fed is trying to provide the message here that it wants to be in control and get ahead of a potential slowdown. And they're hoping that this interest rate cut will provide the medicine the US economy needs. However, it still appears that the Fed will bite the bullet and pull the trigger on an interest rate cut one more time between now and the remainder of 2024.
Right. Some international central banks have already cut rates before the Fed's cuts. Now the Fed has cut the rates. Will it trigger a worldwide new round of rate cuts? And is this impact on the global economy going to be positive or negative?
Well, it was the Fed that was supposed to start this party. But in fact, they've actually been the last one to join this party when you consider the Bank of England moved a few months ago. The European Central Bank have already moved twice this year, along with some other developed central banks. So the Fed moving by such an extent, while we still see inflationary pressures are fortunately easing globally, especially in the developed world, this signals that the other central banks will continue to move. I think that's particularly going to be the case, and more specifically for the European Union, that'd be the European Central Bank, as well as for the Bank of England. In terms of what it means for the world economy, clearly the last couple of years have been a struggle. We've went from the pandemic to the Russia-Ukraine crisis. It's particularly the Russia-Ukraine crisis that led to this inflation skyrocket, which is why the central banks moved rates higher. So the fact that they're able to move rates lower now suggests that they're in control of the situation. It suggests that inflation is easing globally, and that should be supportive for economic growth, especially if we have the return of lower interest rates, although they won't be as low as what we remember them just a few years ago. They're at least moderate from what has been the highest interest rate policy in a generation.
Great, good news. So I'm in China, Jameel, so I'm definitely watching the impact on the Chinese economy. The yuan has significantly increased against the dollar, strengthened against the dollar by over 300 points to 706 now, and people are watching Chinese central banks move. So what are interest rate expectations for People's Bank of China?
Well, when it comes to the currency, I think we have to remember that emerging markets have now been pressured from the start of this decade, because we've had crisis after crisis, unfortunately, economically, which means that investors have not been so attracted towards emerging markets as risk assets. So the fact that we are now starting to see the greenback, the US currency weaken, and that will be accelerated by lower interest rate policy, that's a positive for emerging markets. Now, if we turn the table towards what China can do, I think the concerns right now is the economic data is not consistent. We knew that the Chinese economy was going to slow in the 2020s, but now we're starting to see some questions as to whether it might be a struggle to achieve the 5% GDP targets. I think that they will get there, but it might be a little bit difficult to get over the line. So lower interest rate policy in China or some sort of economic stimulus to support demand and productivity in the world's second largest economy, that would only be a good thing to help China achieve its medium and longer term goals.
Thank you so much for your insights. Love to talk to you again. Jameel Ahmad, Chief Analyst at GTC. Now, the Bank of England kept interest rates steady at